Hello, everyone, and welcome to the Property Trio. And this week we've got our market update, but we're missing one of our musketeers. Mike's hiking around New Zealand. So, Mike, we miss you. We hope you're having a great time. But Dave and I have got this. How are you, Dave?
I'm good, thanks, Kate.
It's great to see you.
There's something happening with the recording. You just froze, and I didn't hear most of what you just said. So I don't know. You're back on normal now. Just as soon as you went into that intro, it just froze.
You know what? I might do it again.
Okay.
So our YouTube listeners might be seeing this twice, but that's okay. They get a peek behind the curtain. Hello and welcome to the Property Trio. This week, it's just Dave and I. We're missing one of our musketeers. Mike is hiking around New Zealand. And Mike, we hope you're having a great time. We miss you, but it's market update. So we've got this.
The show must go on.
It must indeed.
Shout out to Mike.
Yeah.
He'll be fit as a fiddle, climbing the mountains, breathing in that beautiful fresh air in New Zealand, particularly down on the South Island, which I have a bit of a fondness for.
Yeah, it's a lucky thing. But what a time to do it as well. It's like peak market, all busy stations for all of us. And I'm glad that Mike's found the time to go out and have a bit of R&R and enjoy New Zealand. So
it's important.
We've got a lot to chat about today, Dave. We've got the October data out, and I'm super happy because we've got all of the data. We've timed this really nicely with some of the
data pieces that come out later in the month.
That's right. We usually have to wait around for the Westpac Consumer Sentiment Index, and we have to wonder what's going on with the ABS stuff because they're always delayed, but we've got it all. So
there's a few interesting bits and pieces this month, isn't there?
There are indeed. So the first one that we'll chat about is, state of the nation and how all of the capital cities and combined regions have fared over the course of the last month. And what we know is, 1 month is just one data point, but we've got a couple of capital cities there that have pivoted for us, namely Hobart. I'm a little bit surprised about Hobart because it's now had a couple of months of positive activity, and just in 1 month, this little city's done 0.8%, which is significant, although we know that there's always less sales as a total number in Hobart, so the data isn't always quite as consistent and as reliable as the big cities. But nevertheless, it's pivoted and it's maintained it for the second month in a row. What were your takes, Dave?
Yeah, look, well, with Hobart, that's 0.8%. So that's, if that was annualised, it's 9.6%. We know it's only 1 month, but there's a bit of a rise there, isn't there? And, there's a bit of movement in the new listings, isn't there, Kate, which will be correlating with this. But it's almost a changing of the guard with Hobart's new listings. People are holding off selling down there. And we're seeing that in Melbourne and Victoria as well.
Yes.
Whereas people are putting properties on the market in Perth, WA, and some of the cities that have really been strong for so long. So,
what do you put all of that down to? I mean, Perth, I think some people are cashing out.
Yep.
And I think there's always speculative investors who jump in and jump out. I mean, I've never liked the idea of trading property because your trading costs are so prohibitive to making a good profit. But then anyone who bought in Perth 2 years ago and sells now, they will absolutely make a profit even when the selling costs are factored in. Yeah. What do you think's going on in the cities where people are sitting tight and holding on to their stock?
Well, I think where people are sitting tight, Melbourne and Hobart, they feel like it's not a good time to sell.
Yes.
And so they're going, look, let's ride this out. And whereas I think there's absolutely people taking profits now in Perth, and there's so much. I've said this before, but there's so much more data than there ever has been. So people are more informed. Whether that's helpful or not, I think it does cause people to make decisions that maybe they otherwise wouldn't have made because there is so much more data available for them. We know humans are inherently gamblers, I suppose, at the end of the day, and driven by sentiment and emotion. And I think we see that flow through to the property market more than ever. certainly not at the level that we do with the stock market and its daily gyrations. But I think that's a big part of what's going on.
Yeah, I agree with you. And I think emotionally, you get a lot of people that maybe purchased at the peak of the market, whatever location this might be. I mean, we all enjoyed a peak in 2021, 2022, but if they're seeing that a sale would trigger a loss, there's a real reluctance to trigger that loss and to crystallize it. And so people will ride the wave, even if they're sitting on something that they're not confident will perform in the short term. There's always that reluctance to admit to yourself that you got it wrong or that you've got to sustain a loss.
Yeah, there's a real psychology, isn't there? And we've seen it with clients over a long, long period of time, haven't we, Cate? People are really reluctant to sell until they feel like that the sale outcome outstrips the purchase costs. And that, obviously they're not factoring in that it's a real loss due to inflation over the period of time they've held the property or holding costs. People tend to just look at, here's what I paid for it. I want to sell it for more than what I paid for it. And there's a real emotion connected to that. And unfortunately, it does cost a lot of people money because they do tend to hold on to lemons longer. But I think on the flip side, we're probably getting people trying to take money off the table, aren't we now in Perth? And
And look, it's funny, that reluctance. Sometimes it's ego, whether you're just not wanting to admit it to yourself and ego can get in the way of a pragmatic decision. Now, before we move to the next chart, what I did note about this month is combined capitals versus combined regions. The combined capitals all up did 0.2%, combined regions 0.6%. We haven't seen a discrepancy like that in quite a while, not since COVID days, Dave. And the combined capitals and regions have broadly been tracking at a similar pace, but it's looking quite different now. I wonder what's going on with the regions.
Oh, look, I think that's just a function of numbers. I think because of the huge population in Melbourne and Sydney, and because Melbourne and Sydney are not performing well at the moment, they're dragging down the city's number here. And I think when Melbourne and Sydney turn, and there's even more data now coming out about Melbourne, which we'll share as we further go along, that the sentiment tide is really turning towards Melbourne and it's turning away from Perth. So I think when we start to see that shift up, whenever that might be, in Melbourne and Sydney are the real key number. I don't think that is like a broad trend necessarily that, it's a time to get into regions necessarily versus cities. What do you think?
I think you've nailed it. We can't take away from the fact that those two big juggernauts really do consume the data. But I also think borderless investing is so mainstream now.
Yeah.
And we've got a lot of information floating around about good, high performance, large regions. I mean, we only did I think it was last week on Townsville. And that's just one of many large regions that are doing really good things. And I think we're seeing an element of that flowing through the data as well, despite the fact that Sydney and Melbourne figures, overwhelm the data.
Yeah, and I think also I did notice when I was just scanning through listings that listing numbers were generally lower in the regions as well. So I think less, people are holding onto their properties, not selling. It obviously has been flatter now for a little period. A lot of people bought at the peak for escapism during COVID and will be reluctant to sell for the emotional reasons we were just talking about as well. So I think that's playing a part too.
Yeah, and I never want to get so myopic in my own state that I just look at Victoria beyond everything else. But Vic's been interesting with the land tax changes. Our threshold has dropped to $50,000 now, which means everyone in the regions would likely be getting a land tax bill. And despite the fact that it won't be super high, if someone has chosen a Victorian region because of the cash flow, well, the increased interest bill and also the additional taxes and the compliance costs have shaken out a fair few regional investors, and we saw a bit of a surge of people selling for a while there. And I think that investor-led surge is dying down a little bit, potentially in the regions.
Yeah, Yeah, that's interesting. That's an interesting observation. I think we may as well just touch on what the other capital cities have done before we move forward. Do you think?
Of course, yeah. Do you want to run through
So,
them?
sure. So Perth, was the rate of growth slowed down again. So 1.4% for the
It's
month.
still massive though, isn't
It's
it?
still big. It's
Oh,
still
it's
large.
crazy.
Let's face it. But it's certainly coming down. Adelaide 1.1 off 1.3. Brisbane down to zero point 0.7 off 0.9. So, all three of them, we know the trend is your friend, and
Yeah.
they've been showing this trajectory for a period of time. So you suspect this is going; those three cities are going to move towards being flat, um, within 3 to 9 months would be my estimate. Then Sydney was negative 0.1. So that's its first monthly decline since January 2023. So almost 2 years, but it's pretty much flat. Melbourne again, pretty much flat, minus 0.2. Canberra, similar, minus 0.3. Darwin, we know it can fluctuate month to month, drop by 1%. But as you touched on, Hobart jumped up off the page, really, didn't it, from 0.8 to 0.8% growth. So maybe we're seeing the turn there in the Hobart market.
Yeah, possibly. I'm almost ready to call it. I think 3 months in
Yeah.
a row we can say something.
Yeah.
I love this. Yeah. So our next chart that we're looking at segments the capital cities into quartiles, and I think that we've got some really good stuff to talk about here, because there is a bit of a trend, particularly with the bottom quartile. Dave, do you want to explain what we're looking at?
Yeah, look. Basically, we're seeing this trend where, probably due to affordability constraints, higher interest rates, the 3% assessment buffer, the money's going towards the bottom 25% of property values in basically all the cities in the country except for Canberra. So the bottom 25% quartile of properties are either having the fastest growth or the slowest rate of falls, but it's outperforming the mid 50% and the upper 25% quartile of properties in every single capital city except for Canberra.
Yeah, and let's talk about across the board why we think that that's happening.
Okay, so so I think the affordability constraints I just spoke about. We're also seeing more investors coming back to the market,
Yeah,
and we know investors, owner occupiers tend to fork out the most for properties. It's not a black and white statement, but
yeah,
as a general rule, particularly at the top end, it's
yeah.
owner occupiers mostly who are buying the top end.
Yeah, I also put it down to first home buyer activity, and we'll go through the
Yeah,
stats as we get further on because first home buyer activity hasn't surged, but it's definitely remained, pretty reasonable.
yeah,
And I think about some of the areas where I'm encountering really tough first home buyer competition, and it's all the lower price points, obviously. I mean, only yesterday I was battling it out for a really generously proportioned one bedroom apartment here in Footscray, and it's potentially big enough to be divided into, that study being cordoned off to be a second room. So I'm
yeah,
talking about a 62 square metre property. Tick, tick, tick. The banks like them, the first home buyers like them, and I had to fight for it. And
right.
then you go into areas like Werribee, which if you're wanting a house at the circa $600,000 price point in Melbourne, that's one area where you can get that product and it's got amenity. And Werribee has carried a bit of stigma as a location. I don't think I'm being unfair to it, but it's got so much going for it. You look at the train station and the amenity there with the size of the shopping precinct.
It's a
And also,
well-established
it
long-term
is.
suburb. Yeah,
Yeah, got the freeways out there, and
infrastructure.
also a lot is going on in Melbourne's west with infrastructure projects. So, of course, Werribee's been doing quite well. If you look at Melbourne's growth figures and you just look at them generally, you wouldn't be thinking that somewhere is highly competitive and growing at a pace, but Werribee certainly is, and first home buyers are really giving it a nudge.
Yeah, yeah. So we're certainly seeing that play out, aren't we, in the bottom quartile of prices?
That's right. And I think if we look at the top quartile and consider some of the purchase decisions that people made when interest rates were at 2%, we're seeing some of those reverse, particularly the holiday house market.
Yeah, absolutely. And we know that, often if it's the city buyers buying in the holiday house market or the regional market, it's probably more likely to be in that upper 25% quartile
Yes.
versus the bottom 25% quartile. So if we're seeing people reverse those decisions out, there's been hits of land tax, for example, in Victoria for second homes. That's going to be playing a role there, isn't it?
Yeah, that absolutely is. Now let's move on to rents, because we're seeing an interesting outcome here. And what's really interesting is our vacancy rates aren't really adjusting, but our pace of rental movement is. Dave, do you want to talk through these charts?
Yeah, so we're seeing the overall gross yield sitting at around 3.7%, remaining steady, but across the nation. But as I alluded to, as I the last market update or the one before, for the first time on record, Melbourne's yield has actually now risen. I think it might have been just about equal or just below Brisbane and Adelaide. So Melbourne's yield is now 3.68%, and Brisbane and Adelaide's are 3.65%. That's never, ever happened before. And that is, as we know, Cate, that's absolutely a price signal to investors and borderless investors in particular, isn't it?
Yeah,
I mean,
completely.
yeah.
Very much so. I mean, our metrics have really tipped on their heads. And even in Melbourne, we're looking across our portfolio at the rental growth that we've had, and you can, be upset about the taxes and the compliance and the associated costs, but the rents have definitely made a difference to that pain.
Yeah, yeah, and it's a double story. It's not just the rents rising; it's the prices reducing or staying flat when prices are rising in other cities. So a price rise that outstrips rental growth reduces yield. And obviously, if the rental growth is greater than the price growth, your yield increases on your rent. So that might be a little bit complex for some people to appreciate, but yeah, so it's a two-pronged attack, if you like, that changes this number, which is your average yield when you enter into buying the property. And we know investors look very closely at that number. And we know when this number gets out of sync, people tend to get into that market. What does that do? It pushes up prices and reduces yields again.
Yeah, it is a leading indicator, and it's why capital growth versus rental growth looks like a DNA strand.
Yeah, yeah.
I mean, they kind of go out of sync with each other, but in the long term, the rate of growth is aligned.
Yeah, and so you can see here a lot of the rental return curves, if you like, pointing downwards. But there's certainly Perth has the probably the clearest downward trajectory in
Yes.
there.
And what's happening with Hobart? I mean, it's a really interesting city because it's been quite volatile. If we talk about Hobart's capital growth and also its rental performance, Hobart's been nothing other than volatile. The question is, why is there a shortage of rental stock on their market now? I mean, they did have a few investor-led sales, and they had a few sales that were a result of people who had bought during COVID and were wanting out of that market. But I'm a little bit perplexed at this one. And I do ask myself the question, are we seeing more properties going into the short stay market perhaps now that, I mean, domestic travel hasn't been keeping pace with international travel, but I just wonder what's happening in Hobart.
Yeah. I wonder if people are looking for cheaper holidays heading down to Hobart again and, more short stays, more Airbnb. We know that had been an
Possibly.
issue for locals, the amount of Airbnbs really keeping out renters from being able to access properties
Yeah,
previously.
absolutely. Well, I did say it, I think, a couple of months ago when Hobart's figures were looking opposite to this. People don't like making move decisions during winter in Hobart. It's a really cold city. And so you do tend to find that rental
Yeah.
activity surges as the months get warmer. And January, February is always a really active set of months for Hobart.
It's a really good point. And just to speak broadly, the national rents only rose by 0.2%. It's a story we've been talking about now for quite some time, that the rate of rental price increases is really slowing down now. That's back into almost the historical norm levels when you annualise it. So we're back to sort of more normalised rental price increases.
Yes. And I've said it before and I'll say it again. I wonder when that will start to filter through to, political agendas and some of the top headline pieces. I
Yeah.
mean, rents surged and I know that would have hurt a lot of families, but I also think that the rate of slowdown and the fact that inflation is still an issue, there might be other headlines.
Yeah, I think you could be right. And I think if we actually look at an average, not over the last 3 to 4 years, but over the last 15 years, we'll actually find that rental growth has been about in line with wage growth, because
Yeah.
we know it was below wage growth for a decade leading into this period. So it had a bit
Yeah.
of catching up to do. That's the reality.
Interesting observation. Fair call. So we've had a look at gross rental yields. We've talked a little bit about vacancies. CoreLogic had a chart that they coined their chart of the month, and they usually find some really interesting data and pop it in their report. Rental growth is easing, but vacancy rates remain tight. So despite rental values rising just 0.2% in October, the national vacancy rate came in at 1.8%, 1.5 percentage points below the pre-COVID 5-year average. While it's still low, this is an improvement from this time last year when just 1.4 of rentals were vacant nationally. It's still very tight, isn't it?
Yeah, look, it just doesn't feel like that problem's going to go away, is it? I mean, that is a long-term issue, the supply issue. And the government's, I was just reading on the front page of the Financial Review today that there's a push in Western Australia to offer tradies from the Eastern Seaboard $10,000 in cash to move over to Perth and start trying to help kickstart their residential property development market, because there's such an undersupply of units, which is a long-term actual issue with Perth.
Very much so. But I look at this chart and the biggest differential between pre-pandemic and current vacancy rates is Perth and regional WA. So they've really had a shake-up in the last 5 years.
They have, yeah.
Now, the next sets of charts are the ones that I'm a bit excited about. I want to fast forward to listings, because we've always talked about the correlation between capital growth and listing activity and sales activity. And we're seeing the current volume of stock is actually a tad higher than the 5-year average, and it's a little bit above last year and the year before as well. Really interesting. So these are national figures. We've also got individual city figures, but let's talk about this because new listing activity is stronger, but all listings, which incorporates old listings, is actually lower. So what's happening here, Dave?
Well, I think I've spoken about this before. One of the issues with a 5-year average is it doesn't factor in the population is growing every year.
Yeah.
Other than a couple of years during COVID, we've had some of the biggest population growth ever in the last year or two. So, really the 5-year average, you should be adding on the population percentage of growth over that period probably, or something like that, to sort of normalize that number. So what happens is, okay, we've got new listings at a 5-year average. So that's great. There's sort of a good level of listings now, but they're all being sold more than what is the 5-year average of total listings. One of the reasons for that is we have more people in the country. So there's more people to buy the same number of houses. So that's one of the reasons the total listings is lower.
Yeah. I think that total listings, we saw a lot of that get eroded, the older listings when people were really clasping for opportunities and looking for what they could get their hands on. Whereas the new listings, we've seen that really kind of surge since August. And I know in our local market, we had a really high number of listings through September and October in Melbourne. And that can kind of startle people, especially if they're not taking the opportunity to get into the market quickly. So I think that,
Yeah.
a lot of locals here have decided to wait it out and see what happens next year and gauge whether interest rates are likely to drop. We've actually had a lot of investor activity here, but I know
Yeah.
in other markets it's still been a FOMO set of conditions and people have been really busy. I just think that we've been smashed with listings from August, September, October, and we still haven't soaked them up. But what will be really interesting is what happens over December, January, because at the moment, anecdotally, agents locally are suggesting that they haven't got the December rush and that end of year, you know, finalisation of that wave of activity. They're finding that their campaigns are kind of petering out from now. So we've had heavy volumes from September and October. November's been a little bit quieter, and December's looking like the tables might turn from a supply and demand point of view, certainly in Melbourne.
Yeah. So it's a buyer's market at the moment, but watch this space for when that turns. And I think anyone who's sitting on the sidelines, particularly who's looking to buy in Melbourne, should keep listening for the consumer sentiment details. And I've got some specific numbers on the cities and states that shows a real substantial change in sentiment.
Oh, I can't wait. Well, I loved this chart that CoreLogic gave us, and I'll pop it in the show notes. It actually shows the change in listing volumes for every single capital city and region statewide. And what's really interesting is Melbourne in this particular month is down 5.3 on what it was last month.
Yeah.
Hobart is significantly down.
This is a real story, isn't it? Which we
Yeah,
alluded to before. This
it
is a
is.
big part of the changing of the guard. I think
Yeah.
we can absolutely call a changing of trajectories, and maybe, maybe I say I shouldn't speak for you, but I think there's that I think it's quite clear, and there's more information in the consumer sentiment as well. We've got Melbourne listings here falling. We've got Hobart listings falling. We've got Perth listings rising
Yeah.
above the average, which hadn't been for quite some time. And Brisbane are just they're just negative still. But there's a real changing of the winds, I think, in what's happening in the capital cities.
Yeah, I tend to agree with you. I look at Melbourne versus regional Victoria. Regional Vic's up 7.6, but yeah, obviously we've just talked about Melbourne. Darwin's really fascinating. So they've got a surge of new listings, but then when we look at all listings, there's quite a deficit. So I do wonder what's going on there. Darwin's had a spike in activity, but like Hobart, when you're talking about a smaller city, it's a little bit harder because the data
Yeah,
points can be a little bit more volatile just based on the amount of data that we're getting.
yeah.
All right, we're moving through to the consumer sentiment index. And I had a look at this one. I think you're probably going to identify the same point. So why don't you chat about it, Dave?
You sure? Do you want me to
Yeah.
kick it off? Okay.
Yeah.
So time to buy a dwelling index jumped by 11.3%. That's a really large surge. Okay, so that jumped up to 86.8. It's the highest read in nearly 3 years. All right. So what drove that surge? So if we dig into the numbers a little bit more detail, it
Yep.
was the gains particularly centered on a large rise in Victoria. So where there's been slippage over the last years, it has actually jumped the state index by 31.5%. So it's jumped to 101.3. And so people are really believing there's more people thinking now is a good time to buy in Victoria than a bad time. So if we look out at the buyer sentiment elsewhere, it's still relatively weak. It's sort of in the range of 80 to 87 across New South Wales. Queensland and South Australia and Western Australia are at really weak levels. 80 to 87 is New South Wales, Queensland and South Australia. Western Australia is 66.
Wow.
So to me, this was probably, first time ever Melbourne's yields are greater than Brisbane and higher than Brisbane Adelaide price signal.
Yes.
The number of listings is now falling into negative territory, new listings in Melbourne price signal. But this sentiment, time to buy a dwelling index signal is sort of the icing on the cake. 101.3 Victoria, 66 Western Australia.
Interesting. And I've talked about it in past market updates. I'm getting consistent and strong inquiry from interstate buyers. Some of them, they're looking at the value proposition. Others are looking at the timing. And we know that there's a degree of speculation to that. In fact, it's a large degree of speculation because none of us know when it will turn. But what we do know is historically the differential gets to a certain level and it springs back, and we're at that level. So whether the differential could continue to widen, we don't know. But I think that we're already seeing early signs with interstate activity here in Victoria.
Well, we know changes occur off the back of sentiment, don't we? Yeah. And we know listings have an impact on changes in prices as well. And, so these underlying factors are coming into play. They tend to then change the outcome of price trajectories in a location. And so that's why we're talking about what we're talking about.
Yeah, absolutely. Now, before we head to the next section, was there anything else in the index that you wanted to chat about?
I think just with the house price expectations, again, there were some notable shifts across the states. So the index declined by 2.1%. However, the state detail showed a particularly steep fall in Western Australia again. So it fell by 17%. Down to 129.6.
Interesting.
That was probably the main point.
I noticed that our thoughts around economic conditions over the next 12 months tricked up 8.7, which is not negligible. That's a significant figure. Is that because people can foresee that we're likely to have an interest rate cut next year, or is it that the cost of some of the things that have been hurting families has eased a little bit? I mean, at the Bowser, we've certainly seen that drop off a little bit. We saw the impact of the energy grants rolling through. Yeah. We've also had tax cuts for certain income earners. I'm not sure, but I think that the sentiment there could be circling around people's expectation of interest rates and the positive effect that will have on economic conditions.
Yeah, you'd think so, wouldn't you? It's looking more likely that we are at our peak, and it's probably a matter of, does the first rate reduction occur in February or closer to the middle of the year?
Indeed. Well, let's go to lending. I thought this was quite intriguing. We're seeing an uptick in investor activity, and it's showing in the charts. You certainly understand what all of this means from your coalface, Dave. What did you notice about these charts?
Yeah, look, we are seeing investors move back into the market at higher rates, aren't we, than owner-occupiers. So that is very interesting to see, and that's being backed up by the percentage of investors in each city. And we're also seeing lending growing at a steady rate once more across the board.
Well, when we look at the investor activity from state to state, this is a really telling chart. Victoria's the only one that's kind of flatlined. So we've talked about investor sentiment and investor inquiry, and we do have a bit of investment activity here, but clearly it's not keeping pace with with the other states. Tassie is particularly volatile.
Yeah.
WA is telling its story, as is South Australia, actually. And when we have a look at investor participation, percentage of housing finance across all of the states, it's actually New South Wales that's winning. But I think that's a historical measure because New South Wales hasn't got the sharpest rate of investor activity in recent months when we look at that chart.
Yeah. Victoria's numbers as a percentage is of investors is lower. It's down at 31 point. I think that says 0.7%.
Yeah.
Whereas New South Wales 44%, Queensland's 40%, South Australia's 41%, and that's been rising pretty rapidly over the last couple of years. Western Australia's been rising since about 2020, is up at 37%. And Tassie sort of bounces up and down, doesn't it?
It does.
At 27.5%. So other than Tassie, Victoria is 6 to 13% behind the other states, which suggests, again, it's another point of reference that says Victoria has upside.
Yeah, indeed.
So what we can see in the is a monthly change of the employed number of people actually jumped by another 44,000. So it was probably higher than people had expected. So the unemployment rate is still holding quite strong at 4.1%, which is a good thing for the country. It's probably not good news for people who want rate reductions to happen sooner rather than later. But the economy is proving really resilient when it comes to jobs.
Yeah, absolutely. And it's not entirely in line with what we would have been led to believe if you go through the minutes, the RBA board minutes, or you listen to the speeches. We anticipated that unemployment could bite or trick up a little bit, and we haven't seen that. So, yeah, very telling.
And they've said one of their goals to thread the needle is to, keep rates where they are without having to impact unemployment and unemployment to rise. So I get at this point in time, they're achieving that outcome. They just need to make sure that inflation comes down at an appropriate rate of knots. Because here's the rub: is that if the rates, our rates haven't gone as high as most other countries, Western nations a number of them have already started to reduce their rates. But what that means is for the whole population, it feels like life's more expensive.
Yeah.
And so what's the trade-off? Is it the whole population has to deal with higher cost of living, but we keep unemployment lower? Or do some people lose jobs, but the whole population is able to bring down inflation faster, and we have rates higher to make that happen? So that's, it's really a philosophical discussion on what you believe personally.
It's a tough dichotomy, though, isn't it? And that's the relationship.
Yeah, and look, you've got economists, they'll be trained the same thing, trained at the same universities. They have different perspectives on this. So, but the RBA have managed to keep the unemployment rate low, still keep it low at this point in time.
Yeah. Well, last and not least, let's go to the bonds, the bond yields, and have a chat about where you think we're sitting for an interest rate cut, Dave. No pressure.
Look, I think services inflation is proving quite sticky, and
you sound like you've just chatted to Michelle Bullock. I think she's used that exact word.
Yeah, problematic. Yeah. So
persistent, actually.
Persistent.
That's the word she used.
Yeah, and we were talking about this probably almost as much as a year ago, that was beginning to become the problem. the goods inflation was a real issue during COVID, and part of that was because all the issues with ports and moving goods around the world, etc. But that's all opened up. But services prices are still going up, and we're a services nation. Services are hair salons and childcare, which is a big one. That's actually one of the worst areas where prices have gone up significantly. I think it's like 9 or 12% in the last recording. So that's my concern. So if I'm going to stick my neck out, I'm going to say sort of April to June, a little bit longer than some people would think versus, say, February meeting. What do you think?
Yeah. Look, I believe I said at the start of the year that we'd see a rate cut by the end of the year, and I do have to swallow my words because you've said it. So services is the key issue, and our RBA are absolutely determined to have inflation sitting comfortably within the 2 to 3% band, and we're talking trimmed inflation. And we've had a variety of things that could have created volatility that they've accounted for. So the energy rebates was a big one. So we got excited when we saw the headline inflation figure falling, but they were quick to remind us that that's not the trimmed inflation number, and we're still not there. So I don't think they're going to muck around and put a toe in the water and give us an interest rate cut just because we're screaming for it, or there's things are looking like they're heading in the right direction. I think they actually want to see that figure sitting firmly under 3%, and until that happens, I don't think we can anticipate a rate cut.
Yeah, I agree. And so what that means is there's more time for people to get into the market while it's a bit weaker before it does take off. If you're looking if you think you're getting into a market that you think is going to have a positive turn from a rate fall.
Yeah. I think we also need to bear in mind that the likely rate cut isn't going to be a big, substantial one. We'd have to have something unprecedented or something really significant to have our Reserve Board give us, in one go, a full percent. I think even 0.5% would be unlikely. I anticipate if we get any cuts, they won't be greater than 0.25, and they won't necessarily be consecutive. Yeah, it's an interesting one.
I agree with that. Though I expect there would be multiple. History suggests that once there's one rate,
there's a few.
So,
it's such a balancing act for them at the moment.
It is.
Everything's so tentative.
And then, there's a lot of press, and there had been in the lead up that Donald Trump's agenda, and Kamala Harris's for that matter, would probably fuel inflation because of their spending promises. So there's always that risk of what might happen in 2025 with the US economy. Tariffs tend to put up prices as well, and we know Trump's promised to put slap big tariffs on China in particular, but most trading nations. So that's all supposed to be inflationary potent as well.
Yeah, 2025 is going to be very, very interesting, particularly globally. But on that note, we've finished our market update. Mike, I didn't quite do you justice. You're a great host and we do miss you. But Dave, it was really nice being property duo today with you.
It was good to catch up.
Now it's time for us to go mining for our gold nugget property tip of the day.
My gold nugget is for anyone that's sitting back thinking 2024 is my year to buy. It still is. There's still a bit of 2024 left, but bear in mind in the auction-centric cities, the auction campaigns are going to start winding down. They already have started. So we will have a few late auction campaigns that start at the very end of November, and they might be just short 3-week campaigns that finalise and go to auction in that week leading up to Christmas. But realistically, we've only got 1 or 2 more weeks to expect seeing new listing activity. So if you're prepped and ready, get out there.
100% agree, Kate. There's no time like the present. And if you're ready to go, you should always make your own decisions based off your own personal economy and not the big picture macro economy if you're in it for the long run.
Nicely said. Well, I look forward to seeing you and Mike next week.
See you next week.
See you later.